Are you curious about how to create a balance sheet for your business? Join us on Kountin Koins, where I will guide you through the process step by step. Learn the importance of maintaining balance, the difference between basic and detailed balance sheets, and uncover the secret to making it all add up. Unlock the secret to financial success with Kountin Koins, where numbers come alive and your accounting game thrives. Let's talk about balance sheets and what they mean for a business. A balance sheet is a financial report that gives us a snapshot of a company's assets, liabilities, and equity at a specific moment. It's like taking a picture of a company's financial situation. In a basic balance sheet, we find out what the business owns, assets, is equal to what it owes, liabilities. The difference between the two is called equity, which is what the business owes back to its owners. To put it simply, assets equals liabilities plus equity. This equation must always hold true for a balanced balance sheet. Now, a detailed balance sheet provides more detailed information. We break down assets into current and non-current categories. Current assets are short-term assets, like receivables and prepaid expenses. Not current assets are long-term assets, which can be tangible like property or intangible like patents. Liabilities are also categorized as current and non-current. Current liabilities include things like payables and accrued expenses, while non-current liabilities are long-term loans. Equity consists of capital contributions from owners and retained earnings, which are profits saved for future use. Next, let's dive into the process of creating a basic balance sheet. The first step is to obtain a trial balance, which is another accounting report. This report shows the closing balances of all general ledger accounts at a specific point in time. For example, here's the adjusted trial balance of SoulSwipe, a dating app prepared at the end of its financial year on December 31st. The trial balance lists all accounts and balances with debits on the left and credits on the right. At the bottom, we can see that the debits total $87,700,000, which perfectly matches the total credits. This balance is crucial because it ensures that SoulSwipe's trial balance is in balance. And when the trial balance is balanced, it means our balance sheet will be balanced too. In a trial balance, accounts are usually organized in a particular pattern. Above the line, we have SoulSwipe's assets representing what the business owns. Below the line, we find SoulSwipe's liabilities and equity, representing what the business owes. We also include revenue and expense accounts, which we discussed in the previous video when creating the income statement. By the way, if you find these videos helpful and want to support the channel, you can click the join button below. I'm grateful to all the channel members who have already done so. Let's now explore the process of creating a balance sheet. There are two ways, the wrong way and the right way. We'll start with the wrong way. It's an easy mistake to make. The wrong approach involves simply taking SoulSwipe's assets, liabilities, and equity accounts and placing them in their respective sections on the balance sheet. In theory, it might seem correct, but let's analyze the results. The total assets add up to $36,350,000, while the total liabilities plus equity amount to $25,650,000. This discrepancy of $10,700,000 means that the balance sheet is not balanced. So, what went wrong? If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. We made a mistake by not including SoulSwipe's revenue and expenses, which are vital components of SoulSwipe's retained earnings. Retained earnings represent the profits held for future use and are part of the equity section on the balance sheet. Once we include the revenue and expenses, the total liabilities plus equity sum up to $36,350,000, ensuring that SoulSwipe's basic balance sheet is in balance. Remember, a balance sheet captures a snapshot of a business's assets, liabilities, and equity at a specific point in time. On the left side, we see what the business owns, and on the right side, we observe what it owes to third parties and its owners. Next up, let's go into the details of creating a comprehensive balance sheet. The process is similar, but we'll categorize SoulSwipe's assets and liabilities into current and non-current sections. Current assets include cash, accounts receivable, other receivables, and prepaid expenses. These are the assets that SoulSwipe expects to convert into cash or use up within a year. On the other hand, non-current assets consist of property, plant, equipment, and intangible assets. These are the long-term assets that SoulSwipe plans to hold for more than a year. Moving on to liabilities, we'll divide them into current and non-current as well. Current liabilities are obligations that SoulSwipe expects to settle within a year and include accounts payable, taxes payable, accrued expenses, and deferred revenue. Non-current liabilities are long-term obligations like long-term loans, which SoulSwipe anticipates repaying over a period longer than a year. In the equity section, we have common stock, which represents the capital contributions made by owners or shareholders. Below that, we find retained earnings, which indicate the profit SoulSwipe has retained for future use. These retained earnings can come from previous year's profits, minus any dividends paid to shareholders, plus the net profit generated in the current year. By putting all the numbers together, we have $31,050,000 in current assets and $5.3 million in non-current assets. On the liability side, we have current liabilities totaling $14.4 million and non-current liabilities amounting to $1.2 million. The equity section shows $1,050,000 as common stock and $19,700,000 as retained earnings. When we add up the total assets and compare them to the total liabilities plus equity, we can confirm that this detailed balance sheet is in balance. To recap, we have learned how to create a basic and detailed balance sheet. The balance sheet provides a snapshot of a business's financial position, showing its assets, liabilities, and equity. The basic balance sheet follows the equation assets equals liabilities plus equity. In a detailed balance sheet, we categorize assets and liabilities into current and non-current sections. By ensuring the balance sheet is balanced, we gain valuable insights into a company's financial health. Have you ever encountered challenges when preparing a balance sheet for your business? Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit the subscribe button and turn on notifications. So I'll see you in the next episode of Kountin Koins. Happy accounting!